Alrighty, good afternoon everyone. The beers are starting to flow. It's an event on the Gold Coast. It's pretty surreal for me to be here today for a couple of reasons. It's my first in-person event in like 3 years, as it is probably for a lot of you here today. It's my first crypto event. I'm a TradFi guy that made a transition about a year ago into crypto. And it's the first time I've been back here on the Gold Coast for a very long time because I actually started my career in Surfers Paradise, believe it or not, as a stockbroker up in Cavill Avenue, which, 20 years later, I can't imagine a stockbroking office being positioned in Cavill Avenue the way that Surfers has developed. But I'm very grateful to be here, and the presentation today is crypto risk is misunderstood and how it's holding back institutions. Now, maybe if I could just get a show of hands, who here is actually from the institutional finance community? So we have a couple mainly on this side. Okay. Today's presentation is as much for people who are private investors as for the institutional investors. But the question I posit, in my role at Bloomberg Intelligence, and for those of you that are not from the institutional finance world, Bloomberg, other than the TV, which we all see, is actually the largest financial software that's used in the financial industry. If you're a broker, if you're a bank, if you're a corporation, an asset manager, or even a government, you're using our software for data analytics and for trading. Now, my clients that I write research for are TradFi clients, predominantly, the traditional asset managers, the banks and the brokers. And we've all been hearing, whether we're on the institutional side or the private side, the institutions are coming. We've heard this mantra over the last couple of years. And we've had some presentations today which are touching on this very point. We had Independent Reserve, an exchange here, talking about what they're seeing, being at the cold front of having an exchange and talking to institutions. I'm going to take a slightly different tact and talk more about how to model and understand these assets. But we've all been hearing it for the last couple of years, and yes, it's definitely happening. I'm speaking to clients, they're starting to make that transition, but it has been slower than what we would have liked or what we would have expected. So the question here, I'm going to start with some very big picture structural trends, which are behind the reason why institutions can no longer afford to ignore the opportunity that's happening in digital assets and crypto. Now, the modern fiat money system is nothing more than a perpetual motion debt machine. A perpetual motion debt machine. What do I mean by that? Every new unit of currency that is created is done via credit or done via a loan. It's loaned into existence by the commercial banks and effectively the central bank as well. Now, because the amount of debt in the system has grown so large, so excessive, we are way beyond the point where it's going to be paid back in aggregate. The amount of debt in the system almost cannot go down. Now, I say that in light of the last 12 months where we've actually seen deflation, asset prices are falling, but it can't be sustained for long periods of time. And the reason for that, or one of the reasons, is that the return you get on every new dollar in the system or every new dollar of credit is diminishing with every new dollar that's issued. So the rate of return is falling. This means simply that the rate in which the banks have to issue new credit or new currency into the system has to increase at a faster and faster rate, exponentially. So I'm sure for most of us here, we sort of understand those fundamentals of the financial system, but let me just illustrate it even further. In 2020, global government debt increased by 28%. It nearly increased by 1/3 in 1 year. Now, the amount of debt as a percentage of GDP is 250%. That is to say, for every dollar that's produced in the economy, there is $2.50 in outstanding debt. Now, if we take the US government, because it is the central part of this equation, last year, after they paid out entitlements and after they paid for military spending, sort of two fixed costs in their annual budget, they had roughly $400 billion left over. The amount of interest they have to pay on the $30 trillion of debt was roughly 400 billion last year, so they could cover their interest payments. The problem is, this year, interest rates have tripled. They now have about $1 trillion in outstanding interest payments on that debt, assuming the debt doesn't increase, which we know it will. That $600 billion shortfall is going to be, issued through more debt, okay? So if you were a corporation or if you're a household, if you cannot make the interest payments on your debt, you're effectively insolvent. Now, I'm not saying the US government is going to go bankrupt. They won't, because they are in the privileged position of issuing the reserve currency. So therefore, they are able to cover their interest payment shortfalls by issuing more debt, a privilege that none of us here really enjoy. Now, let's look at the other side of the equation, the money supply. In 2020, the Federal Reserve more than doubled the amount of financial liquidity in that system. Here in Australia, the Reserve Bank of Australia tripled the amount of bank reserves in the system. What that means is that money supply in both countries has increased by 30 to 40% over the past 2 years. Michael Saylor pointed this out this morning. So what does that mean for us mere mortals and for the institutions running our superannuation and our pensions? That unless they are able to increase the value of their assets and or the income they receive at the same rates as the increase in the money supply, then they and we are being debased. It's as simple as that. Now, at the same time as what I call the great debasement, this big structural trend is happening, you are seeing technological adoption taking place. Now, for those of you that are in the crypto space, that are developers or perhaps even users, you might be thinking the level of adoption that you're seeing, the millions and millions of new users come into the space, is exceptional or unprecedented. But it's simply not the case. What we're seeing in crypto is very similar to what we've seen in other technological waves that have happened over the last couple of decades, especially the last 2 decades. So here I've got a visual which I'm showing the growth in just Bitcoin addresses. So excluding everything else, just Bitcoin addresses. And we're overlaying it onto the growth that happened in the cell phone or the mobile phone wave. That started really in the mid-1990s and sort of lasted all the way up until really 2010. Now, what you see on the left-hand side is a linear scale. It doesn't look like there is much growth at the start, but when you look at it on the right-hand side on a logarithmic or a percentage scale, you can see that the growth rate is quite fast. It's accelerating at one point, and there is still many years left in this growth phase for crypto. You just heard Binance talking about onboarding 1 billion users. I don't know if they'll get there, but certainly crypto in general will get to 1 billion users within the next 5 to 7 years, based on my sort of calculation. And you'll see that the growth rate in this sort of meaty part of the trend is where obviously you'll still make exceptional gains and then it will moderate over time. Now, these two global trends happening at the same time. Bitcoin and Ethereum are at the intersection of both of these global trends, and this is what institutions are starting to understand. So for Bitcoin, it's trying to solve the world's need for a global, non-state, neutral money, a money that cannot censor those who use it, and that disintermediate the rent-seeking that happens in the financial system as it speaks. And also because it has a monetary policy which by design is the antithesis of fiat, which should help us from the debasement that's occurring. Now, Ethereum and the other layer 1 chains are also riding this technological adoption wave. They are building the world of Web3, and we've heard a lot today, and we'll hear more tomorrow about the world of Web3. It's incredibly exciting, but the ownership economy, the ability for people to create and interact with their customers without big tech, social media, disintermediating them, taking the value that they should rightfully accrue. Now, what's different between Ethereum and the other layer 1 chains is that their supply schedule has addressed the need for, has properties which make it of sound money like characteristics. So I differentiate Ethereum from those other L1 chains based on that characteristic. And both of these assets sit at the nexus of these two global trends. So Michael Saylor quoted some numbers this morning. He did my job for me. But I'm showing you on a chart here something similar. Now, the difference between what Michael's talking about, although he was alluding to it, and what I'm showing you here is that we should stop looking at the returns of assets in nominal terms. Bitcoin went up by 500%, the S&P went up by 87%. It should be the return denominated in the thing that matters, which is the money supply. When you compare the growth of an asset denominated in the money supply, you are seeing the real return, not the nominal return. Because if the money supply doubled and your asset went up 80%, you have lost money in real terms. And what we're looking at here is, since that last round of quantitative easing, of credit expansion in global economies, that the only two assets out of the array of risk assets that we could all invest in, US equities, commodities, gold, Ethereum and Bitcoin outperforms considerably. The rest were negative in real terms. They didn't keep up with the money supply. Now, the criticism for this analysis is that you're not thinking about the last 12 months. We can see that Bitcoin has gone down by 70%. And yes, that's true. There are macro environments where these assets outperform, and there's macro environments where they underperform. But in the backdrop, as I mentioned, is the structural trend that's taking place. Deflation, which is what we're going through now with falling asset prices, almost can't be sustained for long periods of time without the whole system collapsing. So at some point, I don't know when, and at some point when things get bad enough, the banks, the central banks will have to return to an inflationary monetary policy. So over the long term, that is what the institutions are missing out if they're not allocating to the space. So again, the question is, why aren't they allocating? And maybe I should just correct what I just said. They're allocating, but the speed of allocation is perhaps not as fast as what some people expected. Now, there's definitely a lot of reasons, and we can't distill the reason why institutions are not doing it based on one reason, but guess what? That's exactly what I'm going to do today. This survey was interesting. It came out about 2 or 3 months ago. Bitstamp, one of the larger global exchanges, did a very comprehensive survey of the industry. Both private or retail and institutions were surveyed, 6,000 people in total, split between institutional and retail, as I said. Average age 35 to 45, male, female, 24 countries. And what they found was that from the institutional cohort, 3 out of 4 globally believe that crypto will go mainstream and that crypto will overtake traditional assets within 10 years. So I don't really know what they mean by overtake. Maybe it's in market cap value. That seems a little bit optimistic, but it shows you that there is institutional support for the asset class. Now, what was interesting was that Australian institutions, instead of being at around 75%, 80% trust, was around 55%. So there is lower trust in this asset class in this part of the world. And what the Australian institutions said was the main reason, or the challenge, as to why they had not invested, it wasn't because of regulations, which I found surprising. Regulations will be solved, that's coming. What they said, it was risk and volatility. And I thought that was curious, and that's kind of what I'm seeing when I'm talking to clients in my role. So let's drill into this a little bit further. So if it's risk and volatility, how can we address this? Well, the first thing is that if you're a money manager, by definition, you are a risk manager. They understand risk better than anyone. So yes, Bitcoin is more volatile. If we look at sort of the daily variance of Bitcoin versus other assets, about 3 times more than the S&P 500, about 2.5 times more than a NASDAQ stock like Apple. But money managers talk in Sharpe ratios, and a Sharpe ratio is the return denominated in the volatility, how much return you get for that volatility. So if you get a superior Sharpe ratio, then you are getting a better return even if something is more volatile. And that is the case with crypto. They have higher Sharpe ratios. So this brown line is above all of the other lines. That is Bitcoin. and the other lines represent gold, S&P 500, and bonds. And the Sharpe ratio, the 5-year Sharpe ratio for Bitcoin is about 1. It's nearly not important what that number is, in as much as it is above and held above other asset classes over continuous timeframes. So the other thing is that volatility in and of itself is not a bad thing, right? The volatility comes with superior returns, then that asset has qualities that you would use in a portfolio or diversify your portfolio with. Now, the other thing about volatility is it can be easily managed through the position size that you take, right? No one here should go out unless they're fully committed to the asset class and put 100% of everything in crypto, and nor should your pension or superannuation fund. The position size is how they manage the risk. So here I've just done a simulation of a portfolio which invests in US equities in the S&P 500, but it took a position of 1% fixed over 7 years in Bitcoin. And what happened was that the excess return was about 14% from that 1% allocation. The Sharpe ratio, again, was superior to the benchmark, which is the S&P 500. Now, most of you are probably aware of this, but I'll say it again, and the institutional money managers will hate me for it. But 3/4 of money managers do not beat their benchmark year in, year out. If you can beat your benchmark by 3 to 5 years, you're a rock star. So this is a way that through diversification that you can actually improve performance over the long term. Now, the same argument will be leveled at me as I showed on the previous chart, which is, what about the last year? Right? Bitcoin's down 70%, S&P's down about 35%. You would have got crushed. This simulation, that's all it is. It's backwards looking. It doesn't necessarily mean this is what will happen in the future, but this takes into account 2 bear markets of 80% or 80% decline in this period here, and we're in a 70% drawdown right now. So through bear markets of such severity as you see in crypto, you still generate 2% annualized outperformance by adding it to your portfolio, and the price you would have had to pay is on a 12-month Sharpe rate or 12-month performance, you would be down 60 basis points versus the benchmark. So 60 basis points in a vicious bear market versus 2% every year over longer time frames. The risk reward is heavily skewed to taking an allocation in crypto. Now, this is going to be the focal point for the rest of the presentation. So money managers do get those first 2 things, right? They're not stupid, they understand it. Where I think the major problem is today is that money managers, if you're a bond investor or an equity investor, you have models which you've grown up with, which are standard operating practice in financial analysis that are well accepted, okay? Or going back the last 100 years, as equity bond analysis evolved, became more sophisticated, better models came out, better approaches came out, guess what happened to the industry? It blew up. There was more allocation to equities over time as models improved, and it also spurred growth in other types of markets or other products, like quant funds, factor funds. So we're at the point here where in the last 20 years, network value, and the lady from Binance pointed this out, has come to the fore, and it was really developed in the 80s, but it sort of grew to prominence in the 90s because at that time the internet was coming on the scene and no one really knew how to model these companies. They didn't have any earnings, right, in the early stages. They didn't know how to monetize the internet. So they applied Metcalfe's law, and Metcalfe's law in essence is valuing a network, which is, well, the value of a network is proportional to the number of users or the number of nodes on that network. So through that concept, we saw valuations on Amazon, social media companies, be what they are even today. They don't trade on the same multiples as a utility company. And a big part of that is network value or Metcalfe's law. Now, all of these different modeling techniques do or can be applied in crypto, but especially that last one, network value or Metcalfe's law. So we are seeing a maturation of the crypto analysis space. It's moved away from just technical analysis, which prices, and I'm not someone who, I do not criticize technical analysis. I'm a CMT, I'm very much involved in that community, but without fundamentals, without other data points to value these networks, the industry was never going to get mainstream or institutional adoption. So we're at the point now where I think we're starting to see the emergence, and it's not just me, there's many others in the space, that are really putting a lot of thought leadership into how to show institutions how they can model, how they can value, how they can make a decision between this blockchain and that blockchain, or this protocol and that protocol. Right, just a word of warning. We've all gone through 3 years of COVID insanity, the most unscientific era in human history. So whenever someone's talking to you about models, who claims to be an expert, especially one that says they can predict the future, run in the other direction. But models are useful. They give us an ability to map the landscape and give us a better sense. They might not be 100% foolproof, but they can give us a better understanding of these assets, which will, evolve over time. And of course, in crypto, we had our own model disaster, so to speak, which was the stock to flow, which explained the supply side of Bitcoin beautifully. But obviously, if it doesn't explain the demand side for the asset, then it was flawed from the outset. So it's been happening in every asset class and every space of, humanity. So when I'm talking to institutions, depending on who they are, depending on their background, I try to frame these assets in a way that makes sense to them. So these are mental models that anyone can use, which may help you analyze these blockchains or these assets. So the first one is, if I'm talking to someone who invests in equities, why not frame blockchains, this mystical thing called a blockchain, like a company or a business, right? You are looking at the cash flows of that business, fees, transaction fees, and you're investing in the equity. So you can try to build a model which looks at things in that similar fashion, cash flows, balance sheets. Sometimes I'm talking to strategists on the sell side or economists. Blockchains are a lot like a country, okay, or an economy. They have a GDP, the total value of all transactions, or TVL. And of course, within every economy, in order to trade or to trade with that economy, you need to use that currency. So when you're looking at blockchains, in the same way as when you look at currencies, you start making decisions based on relative interest rates, relative staking yields. Those sorts of things make sense. And then finally, really driving home the network value component, you can think of them like social networks that have revenue and a social token. And there you would want to look at the number of users, the number of nodes, according to Metcalfe's law, the developer activity. And if it's decentralization that you're after, you have to look at the metrics which actually measure decentralization. So, what drives the value of crypto assets? I believe it's network adoption, based on Metcalfe's law. So, what drives network adoption? So now we're getting down to the brass tacks and starting to dig a little bit deeper in the models. So I just use a very simple first principles approach. We've talked about the structural trends. Do you have the wind at your back, right? Is that the case with the technology adoption that's going on? Certainly is the case. I've talked about the macro. You have to pay attention to which season we're in, which climate we're in, because there are environments where all risk assets, not just crypto, all risk assets, equities, property, they will do better in certain environments. And it tends to be the same environment that crypto does well. And then you have to map the fundamentals. What is the supply? What is the demand? What's the utility? What's the general health of the network? And so you put all these things together and you get something which gives you a roadmap to understanding asset B versus asset C, D, and E. Okay, so obviously things like token supply. Token supply going up is obviously a negative, right? You're being diluted. It's the same thing for equities. Obviously token demand is a very positive. So these things, these levers, you can actually track in your model. So just diving into the macro for a second before we go to the fundamentals and cover something a little bit new. You have to respect the macro and keep in mind that, as a long-term investor, if the structural trend is debasement, you have to go through the crypto winters if you've got a long-term view. But if you're more of a short-term money manager and you're trying to time things, this can be incredibly important. So if you just want to distill macro into two things, the price of money, the quantity of money. That's all you really need to understand. There's tons of other inputs, and it can get very, very complex. I'm not that smart. I have to make things pretty simple. Interest rates and the quantity of money, the liquidity in the system. And if you just map this out into a quadrant, there are environments, as I mentioned, where if liquidity is increasing, if rates are decreasing, you've got this sweet spot for all risk assets, and obviously crypto. But we are in the polar opposite environment right now. We are in an environment where rates are going up, and they still may be going up for a little bit further, and the central banks that added all that liquidity into the system in 2020 are now starting to pull it out, or have been draining it out of the system. And you know this is true because if you overlay the Bitcoin price with the 10-year Treasury yield, the Treasury yield is in white, and I've had to invert it so I can show the correlation a little bit more clearly. So with that white line going down is actually interest rates going up, and it maps perfectly with Bitcoin. So I just did that for illustrative purposes. So you can see that overlaid, you can see that correlation is there. Now, I measure liquidity. I created an index on the Bloomberg terminal. If anyone has a Bloomberg, I can share this index with you. It's a custom index. But I look at the amount of liquidity from the central banks and from the money managers, the private sector, as well as the US government. And that is that white line here. And we saw that massive stimulation response in 2020. All risk assets responded accordingly. And it went up until liquidity started to stall at the end of last year, and then started to decrease, and asset prices started to fall. Now, Bitcoin has been described by some macro strategists as the last functioning fire alarm in the economy, and that's because generally what you see is turning points in Bitcoin even before equities react. And we saw that actually in November of 2021. Equities continued to rally for another couple of weeks before they started to roll over. So statistically, if you're a short-term money manager, you can improve your returns through timing, but it is a difficult game. I've just created a simulation or a backtest of when the environment has been tight or when it's been accommodative, and clearly you see that the average return in the periods in which liquidity is increasing is substantially higher than during the periods where it is decreasing or contracting. Okay, so jumping into the last part, which is fundamental analysis. If you're in equities, you think of earnings, right? You think of assets and liabilities. These are the fundamentals of the business or the stock that you're investing in. So for crypto, what do we have that behaves or looks something similar to that? Well, we have on-chain data. This is data that is extracted from each of these blockchains, right? And what I've done is that I've created a model which looks at all of those different drivers, and these are just common sense things. On-chain data has been around since 2013, but there are quite a few data providers out there that do a fantastic job of covering what I would call the fundamentals for a particular blockchain or the asset. So things like looking at the demand, right? Transaction fees is obviously a proxy for demand. If people are paying more, they're using it more, right? It also has an impact on their staking yield. So all of these things you can map out. If you're looking at, well, another demand driver is the transferred value. If you are using a blockchain as a network to move value around the world, if you are committing more dollar value investments onto that chain to move on that chain, that's a vote of confidence in that chain, right? So that's another demand driver that you can use. Developer activity. So for proof of stake chains, they want to attract developers. That's another thing that you can measure to see what the health of that network is. Security. For proof of work, you want to track the hash rate and things like that. Proof of stake, obviously the number of validators, how distributed those validators are. not all decentralized blockchains are really decentralized. That doesn't mean that they're not suitable investments. It depends on what you believe is the right trade-off. Okay, so, but these are things that you should be tracking. Now, for traditional finance people, they think in interest rates, they think in dividend yield. So what does crypto have? It has the staking yield. So you're able to compare staking yields across these assets. And then the traditional finance world always talks in terms of ratios, right? Price to earnings ratio, price to book ratio. Network value to transactions, NVT, fantastic ratio, which has a very strong signal in terms of when the network is undervalued or overvalued. The price relative to number of active addresses is another ratio, and I've built up a lot of other custom ones as well. So that's what you can see on the right-hand side. It looks at all the different metrics. For Bitcoin, it's about 35. For Ethereum, it's about 45, because there's a high degree of complexity. I also track the rate of change. So not just the level, but how fast it's moving, how fast the adoption is. So that there is a lay of the land, a framework that institutional investors can adopt and use. Now, why should you track active addresses? Theoretically, we get it, right? Like, an asset is valuable if more people are using it. Well, I've done the regressions and the sort of the backtesting on these metrics and found which ones have the highest correlation. And yes, there's definitely a correlation there. If you look at Ethereum, the price relative overlaid with the number of active addresses, which I've smoothed by 30 days, you can see it's pretty close, right? Price goes up, so does the number of users. Now, which one comes first? Is it the active users or the price, right? That's very difficult to ascertain, but you can track the level of adoption through something like this and the rate of change. If you take the active addresses and you multiply it by the dollar value being transferred every day, you get an even closer model fit, right? So we do know active addresses and the value that's being transferred, they have an impact on price. Now here is a chart of Bitcoin. The first two I was showing was Ethereum. Now there's a little bit more going on this chart, so I'm going to spend a bit of time explaining it. The blue line is the number of addresses that hold some Bitcoin. It's currently around 42 million. Now, if you look at the rate of change, which is this chart here, so higher this bar chart is faster growth, right? The momentum is higher. And you can see in Bitcoin's history, the first, 8-9 years, we had what I call hyper growth, right? There were just more people joining. It was at a faster rate. If you remember back to that S-curve that I showed you with mobile phones, right? You get this pickup and acceleration, then you get a moderation over time. Now, I'm not necessarily saying Bitcoin's hyper growth phase is over. I actually don't think that, but what we have definitely seen, being completely pragmatic, is that the last 4 years we've seen moderate growth, okay? But what is different about this cycle versus the last cycle? In 2018, the last bear market that we saw before the one that we're currently in, Bitcoin suffered an adoption recession. 25% of all addresses sold their Bitcoin and left the network. This bear market, it never went negative on the timescale that I'm using. So yes, the growth was slower, but people's conviction seems to be higher, right? People are hodling more. They know what happens in bear markets. They're not going to be the idiot that sells in a bear market. So it's very interesting that the blue line also tracks the yellow line. The yellow line is just a long-term moving average. So these things are very or highly correlated, but I believe it was this reason why Bitcoin didn't get to the price forecasts that a lot of the personalities in the space were talking about, 150,000, 200,000 Bitcoin by the end of the cycle. It tells me that the actual number of users matters, right? If you do not get the growth in the users, you do not get the price reactions. Really simple. So tracking this is critical. Institutional investors will get this once they see it and begin to feel a lot more comfortable with investing their capital if they know how to track the underlying fundamentals. So I think this is the last chart on the fundamentals. This is Ethereum, and Ethereum price, Ethereum transaction fees or priority fees, the tips that you use to get your transactions done. You can see it goes through phases where it's flat and then spikes up and goes into an uptrend. And I'm using some moving averages to build a trading system. Here is when you see the big gains in Ethereum, the bull markets, the absolute, thousands of % gains. When transaction fees start to really tick up, more demand, more usage, higher price. Unfortunately for the Ethereum bulls, yes, we've had the merge. It's extremely bullish because it cuts the issuance, it cuts the supply. But in my view, you can't have a bull market without demand going up. And at the moment, the demand is still trending down in terms of those fees. We could go into that for hours, but I'm still very positive on Ethereum, but I don't think until we see transaction fees start to tick up and demand increase, just logically, even that supply cut, which is positive, it doesn't mean we're going to see like this new raging bull market. I think macro, right, liquidity, interest rates, that's important, and demand. And there's obviously some interplay between those two. If we start to see interest rates cut, will we see more activity in DeFi? Quite possibly. So these two things are very much interconnected. Okay, so summarizing everything here today. Institutions are investing in the space, they're coming in, they're wetting their toes, but it has been slow up until this point. If risk is really the major concern, they are professional risk managers. They can control it through traditional risk management techniques, and there are ways to actually model these assets. The way I would describe it is just blockchains and networks, Metcalfe's law, traditional models, crypto nuanced way. You can understand these businesses or these assets really well. Respect the macro, impacts everything, and follow the fundamentals. Okay. So that's it for my presentation. Of course, and ask your advisor, your asset manager, why they haven't started investing if they haven't. So if you're interested in my research, you're more than happy to email me. I can put you on my distribution list. My research goes out on the Bloomberg terminal, so it's kind of in this walled garden, but I'm happy to add people to my external email distribution. But I also post most of my research on Twitter as well and on LinkedIn. So I don't know if we've got time for questions. We do not. Okay. Thanks, everyone. If you've got any questions, you can come up afterwards.